gave a talk some years back, 10 commandments of investment management. And one of the commandments is, thou shalt never use Excel. And so if you find yourself reaching for Excel, then you know you don't have Bell Resort and you don't have RACES. So if it doesn't hit you over the head, like this is a total no-brainer. So I think it's a good idea to look at things and read things where things are so blindingly obvious just on the first read. Now, you may need to do more work to fine-tune it, but it should just hit you so obviously that this is worth 10 times what I'm going to be paying for it. And that's the way to go. And Excel is not the way to get there. One of the arrows in our quiver as value investors is patience. In general, we don't really have, for the most part, an information edge. If I'm looking at a business, there's not much I'm going to be able to come up with about that business that a lot of other people haven't figured out or are capable of figuring out. So the information edge, for the most part, doesn't exist. Then there can be another edge, which is an analytics edge, which is two individuals have the same information, but one person is able to look at that data and come to conclusions that are different from the other person. And so an analytic edge can be a real edge. But even that is difficult because there's a lot of smart people looking at a lot of companies. The one edge that is probably the strongest is the time horizon, the ability of an investor to think longer term. And this is one of the reasons why the index does so well. The index is too dumb to know that it owns Microsoft. It's too dumb to know that it owns Alphabet. And it's too dumb to sell these things. And it keeps these things endlessly forever. You look at the S&P 500 index, for example, which is 500, for the most part, great businesses. And every year, they might take one or two businesses out and replace them with one or two new ones, but usually the ones they take out are not the ones that are climbing. The S&P 500 would hold an Apple or a Microsoft or a Amazon or Alphabet for 20 years, 30 years. And that type of holding period on these great businesses can be a great edge. Most humans have a limited circle of competence. So there's no problem with having a small circle of competence. In fact, you can get extremely wealthy with an extremely narrow circle of competence. That is the nature of most entrepreneurs. Their circle of competence is very narrow. They are, in many cases, an inch wide and a mile deep. And it works well for them. So we have to be honest with ourselves and we have to ask ourselves, is this business within our circle of competence? And it might be the case in 98 or 99% of businesses you encounter. The answer is no. Lots and lots of things I will quickly get rid of. It doesn't matter if you get rid of a business that eventually goes up 100 times or 1,000 times. What matters more is to avoid the ones that you don't really understand. So the first is circle of competence. The second is margin of safety. So if you have a good understanding of a company, by definition, you know what it's worth. You can't really have a good understanding and then basically say, I don't know what this is worth. And if you know what it's worth and you obviously the market's giving you a market price, if you see a large enough delta there. So the third thing is be very unreasonable. So if you say to yourself, I want to buy things that are 50% off, you will find plenty of company. If you become more unreasonable and I say, I want to buy something that's 75% off, you will still find company. If you say to yourself, I want things that are 90% off, you'll still find companies. Because the universe of companies is so large, if you are willing to dig through those 50,000 businesses, you'll find them at 50, 70, 90, 95% off. It's a treasure hunt. You're looking for a needle in the haystack and you want 7 moons to line up. And the other side of this is if you made 8 or 10 bets like this and even half of them didn't work, which is probably going to be the case, error rate here might be 50%. It doesn't matter. And if you're right on 4 out of 8 or 5 out of 10 or 6 out of 10, it's going to work out spectacularly. It's a pretty straightforward, I would say, template and game plan. Execution is not so straightforward, but if you're dogged and focused, you can get there. One of the issues we face is that the data set is too large. So when you have 50,000 stocks in the world, and if you were to spend a month on each one, unfortunately, God hasn't given us 50,000 months on planet Earth to go through them all. If you spent your whole life looking at every business, and you started when you were 20 and you went till you were 80, and you would probably get to 600 or 700 businesses in a lifetime. And that's just doing nothing else. And which means that you would basically have only looked at something like 1% of the full data set. We need hacks. There are several hacks you can use. One hack you can use is you could go and look at something like Value Investors Club, which has a rigorous membership requirement, and the quality of the ideas posted is well above average. And so if you limited yourself to only companies that have a write-up on Value Investors Club, that's a much more manageable data set. And the good thing with the Value Investors Club is that you get digested data. So you get both qualitative and quantitative data in a pretty digested form, where someone has spent the time to write it up and is giving you the story and all that. Now, you may agree or disagree or not understand the story, and that's fine. You can let things go if they don't make sense. So that's one hack. Data Roma is another hack, which is a site that lists the major holdings of a bunch of great investors. So if it's already gone through one filter, someone smart that you admire already bought it, that's a great list to go window shopping and then hopefully actually shopping in. So you can do some hacks like that. And then on the other end of the spectrum, other side, if you end up with one or two ideas that you can find in a year that go through all these filters, that's a really good outcome. So if you're able to find one good investment a year, I think that's a year well spent. So I think Charlie must read 400 or 500 books a year. And when he's sitting in his kind of easy chair at home, there's a pile of books on one side, there's another pile of books on the other side. And it's like an assembly line. These books are just pounding through, probably more than one or two a day. But neither the large brain nor that huge amount of data going into his brain is responsible for his success, in my opinion. What I believe is truly responsible for his success is the mental model hacks. What Charlie has been able to do over the last 50, 70, 80 years is that he's been able to figure out certain mental models. When you start putting something like 30, 40, 50 mental models in your brain, when you encounter some company or business that you're looking at, instantly 3 or 4 mental models come and work on that particular business. You are able to get to a perspective on that company relatively quickly and probably relatively very accurately that most of the humans are going to have a hard time with.